Hello and welcome to the Wealth Consulting Group's quarterly market update. Today I'll be walking you through some of the things that we've seen in 2022, and we'll be reviewing what we're expecting for 2023. So 2022 was a rough year for many investors. We had a bear market in stocks that was induced largely by tightening in valuations. The tightening was done by the Fed. Valuations were rich, and this was not due to a collapse in profits. However, also we saw that inflation peaked in the U.S. It looks like it peaks from all indications. We saw some slowing economic growth and some signs of a looming recession, but we did not have a recession in 2022. As defined by the National Bureau of Economic Research. We saw employment and consumer balance sheets still strong. Now, the ongoing conflict in Russia, Ukraine has added volatility to both commodities and energy prices, as well as electricity prices, and that's particularly the case in Europe. Now, toward the end of the year in 2022, we had China reopening. That we believe it will likely add to some global economic growth, but we may also see some higher pressure on energy prices as it relates to that. So technically, looking at the S&P 500, we are holding above kind of our trend line here. We're holding above the moving average. And technically, we're showing some signs of momentum. We would like to see more, but this is something that we continue to look at. With the new year, there's some seasonality. We're getting right into profit seasons. We've had the dollar come down. We've also had interest rates come down, and so that has been helpful so far for 2023. When we look at the sectors that have been performing the best relative to the markets, it's this blue line up on top here is energy, and to the extent that people have had a little bit more exposure to energy than the market, that has certainly helped their portfolios. For individuals that had overweights and consumer discretionary and communication services and in technology, that has actually hurt portfolios more. Now, we like to look at breadth. We like to see more participation of the individual companies of the S&P 500. One positive sign that we've seen here recently is that there is a good number of companies within the S&P 500 that are trading above their 200-day moving average. So right now it's around 62%. We like to see that a little bit higher, but this is actually compares very well compared to earlier periods where the market was in a drawdown and we had some lows. Now, this does not count the companies that have already bottomed and have started coming back up, performing well, that have not quite gotten to the 200-day moving average, but they're doing better versus a 4-week moving average. So all of these things look good. We will continue to monitor this and measure it. Now, with inflation coming down, we may also see that volatility comes down. So really, with the Federal Reserve, there are two paths for them to lower rates. First, they need to pause before they lower rates. But the way this happens is they're either going to do it because economic growth not only comes to a standstill, but it turns negative. We have a recession, unemployment spikes. That's one scenario where they would cut rates. The other scenario is for inflation to come down significantly, for them to say, okay, what we're doing is working. We don't need to have rates this high. We can bring these down now. So all of that also would point to lower volatility. Now, when we look at interest rates, most parts of the yield curve, and this is the yield curve here, a graph of the yield curve, the black line being current, most parts of the yield curve are highly inverted. That means that rates that are very, very short term, 1 month, 3 months, 6 months, are paying more than buying a bond that goes out 5 years, 7 years, 10 years, or even 20 or 30 years. So this is a unique situation. Typically, when this happens, it's not good for the economy going forward, and it is often indicated that we will have a recession. Now, when we look at the 3-month and the 10-year in particular, this is much, much wider than we've seen the last few times that we've had a recession. And so a lot of individuals are thinking that we may have reversion to the mean with bonds, that some of these short rates will come down, and we'll also have some of the longer rates come down. Now, Guggenheim recently put out a piece that talked about the difference between the 3-month and the 10-year treasury that we just looked at. And they said that 1 year later, on average, this is the performance of bonds. And so for US securitized bonds, for the Bloomberg aggregate, for investment grade corporate bonds, the returns on average have been 8 to 8.5, 9%. And so this could be a good year for bonds based on this. Now, another indicator that goes back even further, that is perhaps a more accurate indicator in terms of recessions, is looking at the unemployment rate. Now, when we look at the unemployment rate and we look at the past recessions, all the recessions are here highlighted in pink bars, vertical bars. Every single time we've had a recession, we've had the unemployment rates spike higher. And that's actually moved higher beyond 5%. By the end of the recession, it's well above 5%. But this is a unique situation where we have this yield curve that's highly inverted, and yet the unemployment rate is still near multi-decade lows at 3.5%. So this is partly due to strong labor market. That strong labor market, there's a lot of people that have left the labor force, and so those people are not technically unemployed because they're not in the labor force. But when we look at initial jobless claims, there have been some layoffs. We will continue to monitor this. We have not seen a spike yet in initial jobless claims. And when we look at payroll, job creation, and people that have jobs, this number is still high. Now, I mentioned that there's a certain number of people that are not in the labor force. There's about 5 million more people that are not on the labor force compared to during COVID. And so these people could have retired early. There could be some illness or disability. There could be any number of reasons, lack of childcare. Now, if these people decide to all come back, even if we get a couple million people that decide to come back, that would push the unemployment rate higher. So that, along with all of the layoffs that we're seeing with companies like Microsoft and Google and Meta and many other companies, when we aggregate all those together, if we see about 2 million people come back into the labor force that don't have a job, then that is something that we will continue to monitor and look at. But we're not yet at a period. The labor market is very tight, so we're not in a period where we see that. Now, inflation is coming down. This is from JP Morgan Asset Management here on the left. Everything to the far right, you can see is green. That means inflation is coming down. These numbers are negative, so green is good. However, the core services area that looks at shelter and rent and owner equivalent rent, these things are still high. And so there is a lagging component of the housing market and rentals that this is going to take some time for it to come down. The chart on the right shows the shelter, the month-over-month increases. So we've had more inflation here. Now, when this comes down, along with everything else, this could be a period where core inflation comes down significantly. Now, when we look at the Federal Reserve's preferred measure of inflation, it's the core PCE, and that's the orange line here. When we can look at that, we can see that is coming down. We can also see the Fed funds rate is the blue line. So for several months, the Federal Reserve didn't do anything. They weren't raising rates. They probably should have raised rates in the middle of 2021 or even early 2021 when they saw that inflation was spiking. They thought it was transitory or temporary, but it wasn't. And so they got a little bit behind the 8 ball and they're in catch-up mode. Now, the good thing about this is the Federal Reserve is just about 50 to 75 basis points or half or 3/4% away from their terminal rate that they've telegraphed of 5%. Now, the PCE, the core PCE, is already below 5%. So we may quickly be in a situation where we see that the Fed funds rate is higher than what the actual inflation rate, the inflation number that they look at. So that would give them the ability to pause. And if that inflation rate keeps coming down dramatically, they can also cut rates. Now, we mentioned before, there is kind of a lagging correlation between inflation and the growth in M2 money supply. M2 money supply is the orange line here. You can see going all the way back to the 70s that every time we've had a large spike and money supply growth, that has been followed by inflation. So all of that inflation that we had back in the 70s and early 80s can be partly attributed to this growth in money supply. Now, recently, the growth in money supply that we've had was far more than any money supply growth that we've ever had, going all the way back to the 70s. And that was during COVID. You know, there were checks getting mailed out to individuals. There was a lot more unemployment benefits. There were these PPP loans. There was a lot more liquidity. The Federal Reserve was buying up securities in the open markets, and they removed reserve requirements. So there was a lot of things to grow the money supply. Now, that has come down to zero recently. The growth in money supply has come down dramatically. We also see the blue line here, that's inflation. It's coming down. Again, there's a lagging effect here, so it will likely continue to come down. And when we look at things like high yield spreads, this is a good indication of financial health for corporate America. We're not seeing a lot of defaults. We're not seeing a lot of downgrades. A lot of those companies that did have poor financial health were able to refinance at very, very attractive rates during the pandemic. And so this is actually a very good sign for corporate America. Yes, we are seeing some sectors such as technology and consumer discretionary where there are more layoffs. Those sectors are coming under much more stress than some of the other sectors that we're looking at. Now, savings rates for U.S. Consumers has dropped dramatically. But keep in mind, we got to a point where everyone was working at home or staying at home, and we had the savings rates close to 35%. And so naturally, it would make sense that this would come down. We're a little bit concerned that it's still very, very low relative to kind of, what we would like to see on average of 5 to 6%. But there's some demographics that are needing to spend more just because of the higher inflation. So we will continue to monitor this. One positive thing with the U.S. consumers is that the U.S. net worth, the aggregate net worth as a percentage of disposable income, is still quite high, very high relative to where it was coming out of the financial crisis and relative to where it was coming out of the technology bubble in 2000. So consumers are in pretty good shape here, and that is actually good for the economy. Now, profit margins have come down. They may continue to come down some, but we're coming down from a very, very high level, record level in terms of profit margins. Now, earnings growth, that has actually tapered off, and forward earnings guidance has moved lower. There were a lot of people that were expecting earnings would drop much more than they did in 2022. But we've been pleasantly surprised. We will continue to monitor this always to see, what changes are coming to. But for now, earnings have been very strong, very robust. So final thoughts here. There's really two main paths for rates to come down. A hard landing, which means that we have a recession and the Fed just stays too tight for too long, and they push us into a recession by making financial conditions just too tight. And that means much more layoffs, higher unemployment, and negative GDP growth. There is another path, however, and I think this path is looking a little bit clearer more recently, and that is the path of a soft landing. This means that we don't have a recession, and the Fed is able to get inflation under control, and we see that inflation comes down sharply, and then the Fed is able to pause, and then at some point start cutting rates. So I think as the potential for a soft landing increases and inflation falls, volatility will likely also come down, and stock multiples will most likely increase. So that would be good for stocks. It would be good for bonds as well if the Fed is signaling that they're going to cut. So consumer savings rates have dropped to multi-year lows, but their net worth is still in a very good place as a percentage of disposable income. Corporate profits haven't declined too much, and default rates are low. Balance sheets are still mostly healthy. So 2023, in short, could be a good year for both bonds and stocks. This could be the opposite of what we had in 2022, where both stocks and bonds performed very poorly. This could be a year where we get very good returns for both stocks and bonds. And here are the final disclosures. Thank you for watching this. We hope you have a wonderful 2023. Thanks.